Right, so this is where we were on corporate credit spreads. All right. Okay, so we keep it at 100. Can you guys see? Sahil, can you see on the last bench? Okay, so we were discussing corporate credit spreads. So one of the things you have to remember is that whenever you're tracking the total cost of debt for a corporate, obviously what are the two components of the total cost of debt for a corporate?
Government bond yield plus credit spread.
Yeah, so the government bond yield plus the credit spread. Okay, so when you are doing what we were talking about, I think we had used this link for the BAA credit spread. So what we were talking about is essentially how I think the last part of the discussion in the previous class was on why in everything you do in finance you'll have to basically take a view on markets.
Yes.
Because if you are working for a corporate treasury and you're doing a debt capital markets issuance, you have to take a call on. Now, normally what happens is if you do the paperwork, okay, you do the paperwork and you have a certain window. Like for instance, in India, you have something called a shelf offering, which is there internationally as well. But the rule in India is if you do a shelf prospectus, you have a 1-year window. So you can get all your legal pay. That's meant to basically allow people to time the market properly, okay? So you do a shelf prospectus and then you have a 1-year window. Any time within that 1 year, you can go ahead and execute the issue. Okay, so this is what happens. So there are different time frames in different jurisdictions. The time frames will differ, but typically that's how it works. You get the legal approvals, regulatory approvals, and then you wait and you have a certain window in which you can make use of that time and optimally time the market. So every kind of corporate decision with regard to finance involves taking a call on markets, because obviously if you decide that you're going to go ahead with the issue, that means one of the things, if you assume that the corporate bond yield is not going to change much, okay, so here we're looking at the spread, okay, here we're looking at the credit spread, okay, because it's corporate bond yield minus 10-year treasury. So we're looking at the credit spread. So you can notice it's around 2.5%, it's 2.3%. So if you go ahead and do the issue, and let's assume that you feel that the corporate bond yield, the government bond yield is not going to move much, okay, it is constant, we'll come to that. This is the ceteris paribus assumption. Essentially, if you're assuming, if you are going ahead with the issue, that means you feel that corporate credit spreads are likely to rise further. That is, your total cost of debt will go up. This is clear? A ceteris paribus argument. If you're just assuming that the government bond yield will not move, okay. So essentially, what that means is that takes us to the next part of the discussion, which is that you have to be tracking, but obviously in real life the government bond yield also moves. So if you are, the point I'm trying to emphasize here, because this entire module is on the skill sets that you need to operate in different roles in the financial sector, right? So one of the skill sets, because remember in corporate treasury the most important function is capital raising, and the bulk of capital raising is in the form of debt. So one of the important jobs you'll have is one of the important skill sets you need to have is how to optimally time the market. Obviously that's not a science, okay, you have to evolve, but you have to focus on this aspect. This is what you have to be focused on. You have to be tracking the credit spread, you have to be tracking the movement of the credit spread and taking a view on which way the credit spread is going to go, and you also have to be tracking this is the US 10-year treasury, which is what has been subtracted from the total corporate bond yield to give you the credit spread, okay. So remember, the market normally works in terms of the debt market discussions which happen, as you will see in the Saudi bond pricing case. They don't normally involve in the case of corporate bonds and for any sovereign which is not issuing in its own currency. So if Argentina is issuing US dollar bonds, they will get treated like any other corporate as far as the discussion, the framework of the discussion is concerned, okay. So so what will happen is you will basically, the discussion in the market is in terms of the spread over the treasury, the spread over the government bond benchmark, if we want to talk in general terms, okay. If you want to talk in US dollar bond, with respect to the US dollar bond markets, we can talk about the US treasury. So when you're talking about US dollar bond markets, the discussion is going to be of corporate bond pricing. The discussion of corporate bond pricing is going to be in terms of a spread over the treasury. They will not discuss it in terms of an all-in rate, okay, because everybody knows where the treasury is, they know how to find out the yield on the treasury. So the discussion is only in terms of the negotiation happens in terms of spread over the treasury. So yeah, what I'm trying to say is, if you look at the debt market parlance, okay, how the debt market discusses corporate bond issues, okay, essentially what they would discuss is they are going to discuss the whole corporate bond yield. Okay, the yield on the corporate bond, they're going to discuss it in terms of a spread over treasuries. They will not discuss outright rates. Okay, they will not discuss an all-in yield of 6%, 6.5%. They will discuss the negotiation that happens. Okay, the negotiation that happens is in the form of a spread over treasuries. So the investor, when the institutional investor, if you're like on the distribution side of a debt capital markets operation, okay, if you're on the distribution side of a what distribution will happen in primary capital markets or secondary capital markets? Primary capital markets. So if you're within the the DCM division of an investment bank in the primary capital markets, if you're on the distribution side, if you're going to investors and trying to sell them various bond issues like Argentina is coming up, Intel is coming up, okay, and with bond issues, and you're trying to sell them to the investor. So the investor, the institutional investor, is going to ask in terms. So he's going to ask, okay, I'm happy to buy this Kingdom of Saudi Arabia bonds, but what spread are you paying over treasuries? Okay, and remember the other point that we discussed. Every time you discuss an interest rate, you have to always be clear about one is the tenor. What tenor are you talking about? And the other is what is the credit grade of the issuer?
Rating.
The credit rating of the issuer, okay, or credit grade of the issuer. So essentially the issuer's name, and then from there you find out the credit grade, because without that it doesn't make any sense. Because as you can see here, at any point of time, this is only the BAA spread. If you look at this chart, at any point of time, obviously you can see that the higher rated corporate bonds have a lower spread than the lower rated corporate bonds. Okay, so therefore, unless you have also specified the credit grade of the issuer, the discussion of the interest rate does not make any sense. It's not complete. Is this clear? Okay, so the point that will happen, the discussion that will happen between the institutional bond investor and the distribution guy from the DCM division within the primary capital markets of an investment bank is going to be, the guy will say, the investor, the portfolio manager who is going to be buying the debt, is going to say, okay, I'm happy to buy the Saudi bonds, but what spreads are you offering over treasuries for each of the maturities?
The treasury would be Saudi Arabia treasury only.
No, if you're using in US dollar, if you're issuing a US dollar bond, you will be benchmarking against US treasuries. Okay, if you're using a Japanese yen bond, then you will be benchmarked against Japanese government bonds. Okay, so that's where that's how the benchmarking will work. So is this point clear? That the discussion in corporate debt markets happens in terms of credits for corporate debt will happen in terms of a credit spread. The people don't discuss how much are you going to pay me, 6%, 7%. They will say what BP spread are you paying for each tenor? Okay, what BP spread over treasuries. So if you're working on the corporate treasury side for a corporate trying to raise debt, you have to monitor both. You have to monitor because both of these things will affect your total cost of debt. So you have to keep an eye when it comes to timing the market. If you look at this, if you take the maximum data, we don't have a lot of data here. You have to be aware of these long-term cycles. At least we have it from say 86. You can see how credit spreads have moved for BAA, which is just about investment grade. One notch below this, you go into junk. Okay, so you should have a historical perspective. You should always look at long-term charts. You should have a historical perspective on credit spreads and where do you think they're going. That's one thing you have to track, and you also have to track obviously the treasury bond yield as well, right? Because that is also going to affect your cost, because your total cost is credit spread plus bond yield, and this bond yield is not constant obviously in the real world. Although we assume that as part of our ceteris paribus discussion of the credit spread just a while earlier, but in the real world, as you can see, the bond yield is not constant. Okay, so therefore, you'll have to monitor both, because both of them are affecting your your total cost of debt. Okay, you have to take a view on both the markets and then accordingly take your decision. Is this clear to everybody? Yeah. Yes, I'll give him the mic if we can. Let's use the mic if we can.
So credit spread will be different for different maturity.
Yes. We'll see that.
Higher the maturity, higher the credit spread.
Not necessarily. It depends on the market's view. Remember, higher credit spread is if a credit spread is higher. Let's go back to the original form of the discussion. If the credit spread has been rising That means what is the debt market expecting? What does that tell us about? So that means the debt market is expecting an economic downturn. Okay. So if, let's say, for instance, now some of the people in the US have the view that there's going to be a recession in, say, 2019, late 2019 or 2020. Okay, but by late 2020 it will recover. So if that is the market's view, then obviously it will affect the views of, let's say, 2-year debt, 2-year at the 2-year point.
Yes.
Credit spreads might be a little bit high. Okay, but if the view is that after that there will be a strong recovery, then maybe for 5-year debt it won't be so high. So it is possible. It's not necessary that credit spreads will always be higher for higher periods, for higher tenors. Normally you would expect that, but it's not necessary that it's always the case. You have to be. This is not a law of physics, because it depends on market views. Okay, so it can change. But the point is that there will be different credit spreads, obviously, for different maturities. Okay, so now if we go back to our, so is this point clear that as a corporate treasury, you'll have to monitor both. Your total cost of debt is affected by the government bond yield as well as the credit spread. So you have to take a view on both the markets. Okay, and then accordingly do your time your bond issue. Okay, so let's go back to okay, now let's look at this case that we are doing in for the Saudi bond issuance. This is actually a real this is all real stuff that actually happened in the markets. Okay, so all the pricing is taken from these. Unfortunately, these things have now gone. These articles have now gone behind a paywall, so I can no longer read the full article. Okay, but you guys will be able to read 10 articles, and after that, you get hit by the paywall. Okay, so anyway, so what you can do is you can read the full story. Maybe what you can do is, because this is it's an interesting story, so maybe what you can do is open it up first. Because you'll be able to read the full story, then save the story as a PDF. Okay, screenshot is not nice to look at later on. PDF is much better. I think if you try to print it, it goes into a PDF. If you try to save it, it goes into a PDF, right? Then save it as a PDF, then you have it online. I mean, you have it available, right? Offline. Okay, so what happens is initially Saudi goes into the, and this is what I said, okay, the indicative, there's this concept of indicative pricing and final pricing. So the indicative pricing is the basis on which you have the discussions. So you do a roadshow, you go into these, so the first story you'll notice is on, based on market talk, based on the Saudi Treasury team going to various centers like London, New York, trying to meet bond investors. This is called a roadshow. You know what you heard this term, roadshow?
Yes.
Okay, so this is called a roadshow where the potential issuer goes to various financial sectors and talks to potential investors. So you have a meeting arranged, okay, and you talk to the investment bankers will arrange meetings with all the potential investors. And then the issuer goes and makes a presentation to these investor teams, okay, at these roadshows. And this is how and that's where they discuss the indicative pricing. So as you can see here, the initial indicative pricing was, can everyone see clearly?
Yes, sir.
Everyone can see?
Yes, sir.
Okay. So 5 years, 160. Okay, this is what does 160 mean?
Sorry.
Yeah. So what does that mean? That they are offering 1.6%. They were discussing when they were doing the negotiations. Okay, I want to sell bonds, and this is what I'm thinking of offering. Does that suit you? And then you go back and forth on the negotiations, etc. So initially, when they started the discussion was in terms of the indicative pricing was in these terms. Okay, 5-year this, 10-year this, and 30-year this. Okay, these are and the total issue size. That is also something of interest. So typically, you also disclose what is your rough amount of issuance that you're looking at. Is this clear to everyone? This is how the discussion happens. And so this article, you'll notice that it says that the spreads are 60 BP, on average the spreads are about 60 BP higher than the Qatari bonds. The Qatari sovereign dollar bonds that are trading, that is about 60 BP higher than, the yield on those Qatari sovereigns are actually 60 BP lower across the curve here compared to the Saudi indicative pricing. Okay, right. So Qatar is known for which commodity? What? Not airline. I said commodity. Qatar is no. You guys should know this. Qatar is very close to us, and we have actually a very big deal with Qatar. Natural gas. Qatar has, I think, the world's largest reserves of natural gas. Okay, and we had a big natural gas. We still have that arrangement. We changed some of the terms of the arrangement. So India buys a lot of natural gas from Qatar. Okay, so now, so this is basically these are all things that you guys should be aware of. Okay, so eventually what happens is, so this is how the indicative pricing happens, and the eventual pricing turns out to be much better because when they actually launch the issue, okay, after the indicative pricing, they will actually launch the issue, and then it goes live. Okay, then you're supposed to submit bids. Okay, and eventually what happens to the final pricing? Can you see? Is it better or worse? Here I've already given you the clue. So I should maybe delete this. No, you've already seen the answer. You've already seen the answer. So if this is the indicative pricing.
So this indicative pricing is credit spread.
Yes, that is what I was telling you. That in debt capital markets, the discussion on bond deals is basically on corporate, any corporate or any sovereign who is not issuing in their own currency. Like Kingdom of Saudi Arabia is a sovereign, okay? But because they're not issuing in Saudi riyals, they are issuing in US dollars. Their discussion of their pricing will also be the same as if, like, say, Airtel or Intel issuing bonds as a corporate. The discussion framework is the same. Okay, is this clear to everyone? Okay, so the final pricing is much better for Saudi. Can you see that? 5-year drops from 160 to 135. 30-year drops from 235 to 210. This is the final pricing. So finally the bonds were issued at these spreads. All right. So if I just
this was the first offer price and this is the accepted price.
Yeah, that is the initial discussion. Like if I'm trying to sell you my house, I'll say I want to sell it for 2 crores, and then we go up and down on discussions. Then you say no, I can't pay that much. Can you make it 1.9 or something like that? And then eventually maybe the deal will go through at 1.92 or something like that. So that's how it happens, right? So is this clear? Okay. So the final pricing, as you can see, is this is how. So eventually, what you see, and then you see something else here, that there is the what happens to the total issue size. They start out by discussing 10 billion.
So increase.
It is increased to 17.5 billions. Okay, 17.5 billion, because there is excessive demand for the very high demand for the bonds. When they launched the issue, they found that there was very high demand for the bonds. Okay, so that's why that explains the collapse in the spreads. That explains the collapse in the spreads from the indicative pricing, but the indicative pricing is just 1 or 2 days before the actual, if you see the report, okay?
We are saying the difference in the pricing because bonds are actively trading in the market of the US, but in case of India, it is not possible to have this pricing difference.
No, 1 minute. Let me just explain what I'm saying. The point I'm trying to notice, why are we discussing this caselet? There are 2 points to notice. Obviously, you have to learn that, which we have already discussed earlier, that the discussion of when a corporate debt issue is being priced, okay, the discussion is not in terms of an absolute yield of 6.7 or 7.2. The discussion is in terms of spreads to the benchmark. The entire discussion negotiation happens in terms of spreads to the benchmark. That is how the discussion happens. Okay, and then the other thing to notice is that because there is excess demand, so there is also something called indicative pricing when they discuss in the roadshows, and then you have the final pricing when the issue is launched. This is when you're launching live, when you're putting in live bids. The institutional investors, the bond investors, they will have to put in live bids. That means you're good for this amount. Okay, then you enter, like if I want to buy 500 million, if I'm working for, say, PIMCO as a bond fund manager, I will have to enter a bid for 500 million. That means that's a firm price. I mean, that's a firm commitment. Okay, so I'm signing up for 500 million 10-year bonds at a yield of 165 over. Okay, that means that this pricing is fine and I'm entering the bid. Okay, so this is final pricing. So you have indicative pricing discussion, then you have the final pricing. So the other point to notice in this case is that the indicative pricing was at a certain level, but when the final issue goes through, the pricing is much more favorable to Saudi Arabia. Yes. And the excess demand for the bonds, because there's excess demand for the bonds, it causes 2 things to happen. It causes the indicative spreads to collapse, Okay, the final pricing is much more favorable than the at much for lower spreads. And the second is that also gives Saudi Arabia an option to upsize the offering. Like when you go to McDonald's, they ask you, right, if you want to upsize, your meal, right? Huh?
Every time we do this, and at last we find it was more expensive
What?
by opting for a meal.
Okay, at McDonald's. So the Saudis have upsized their bond issue. Okay, so they have opted for, this is called a green shoe option, where there's an option to basically increase the size of the issue. You'd have a discussion in terms of 10 billion, but then finally you end up issuing 17.5 billion because you find that there's very strong demand for the bonds. So the point to notice here is that when you have excess demands, two things can happen. That one is that the indicative spread will collapse in the final pricing, and the second is that the size of the bond issue can be increased, okay, by exercising the green shoe. Is everyone clear now? Okay, so this is how debt price is. So eventually what will happen is when you see the final newswire, if you're monitoring newswire, if you're working corporate treasury, you will see that, let's say whatever, we just talk about one of those. I'm just giving a due 30 years from 16 is 46. Price 30 was priced at 210 over. Okay, so the news feed that you will see if you are monitoring, in corporate treasury, you will have access to wires like International Financing Review, etc., which cover the capital markets, who is issuing where, anywhere in the world. So those wires will give you a news release, something like this: KSA 5% bonds due 2046, priced at 210 over. Okay, what this means essentially is that
5%
this
coupon rate.
5% is the coupon rate.
Yes, and 2046 is the maturity.
Yes.
And 2010 is above, that is
Not 2010, 210.
210, sorry, above indicative pricing or above base points, that is over.
Don't say indicative pricing anymore, because this is price. This kind of report, when it comes out, means
Final
that
pricing.
this is the issue has already been launched and completed. Okay, they're reporting on the issue completed. So priced at 210 over means this has been the final price based on the interaction of demand and supply. So 210 above treasuries, which means you have to work out. This is obviously coming out. You know which
This is
date.
the increased size of the offering.
Yeah, I wrote 2046 because this case study is from 2016. So the 30-year bonds will mature in 2046.
Yeah.
So the 30 years. So this is how the news release will come out. KSA 5% bonds due 2046, priced at 210 over, which means you know that Kingdom of Saudi Arabia credit risk has been priced at 210 over 30-year treasury.
210 final price.
210 is the final price. Okay, so 210 over means now if you want to find out the total yield on that, you'll have to go and find out what is the 30-year treasury, US treasury yield. Go to the US treasury website, go and find out what the 30-year US treasury yield is, and then you will add 2.1% to that, and then you'll find out how much Saudi Arabia paid on an all-in basis for 30-year bonds. Is everyone clear?
Yes, sir.
Okay, all right. So all this stuff is already written here. Okay. And then obviously what happens is if you do floating rate stuff, okay, now so far we've discussed fixed rate. If you do floating rate, the same concept, so we'll try to save some time by not increasing. If anybody has a problem, you can ask me later. Okay, so the same thing, let's look at another example. So floating rate LIBOR, everyone understands?
Lender interbank
Okay.
offer rate.
Okay, and what is HIBOR? HIBOR is an I5, HIBOR. Haryana Interbank offer rate. Think of any other big financial center which thinks about London is big.
Hong Kong.
Hong Kong interbank offer rate. Okay, so you have LIBOR, you have then we also have MIBOR as well,
MIBOR.
Mumbai interbank offer rate. Okay, so then you have SIBOR for Singapore.
Yes.
Okay, but the big center essentially is London. The big international capital markets center is really London, and also New York is very big because of the size of the domestic capital markets.
So what is this 5%?
5% is the coupon. So they mention the coupon. So obviously if a bond is issued at par, okay, and then if you see the YTM on the bond, okay, if the bond is issued at par, the YTM will be what, more than the coupon or greater than the coupon?
Greater than
Issued at par, sir.
If it is issued at par, the YTM is the and the coupon will be the same. Okay, so essentially now, so you'll find out that this 5% here is referring to the coupon rate. Okay, coupon rate and when is it due? Okay, all right. Now, so okay, LIBOR. What will happen in LIBOR if you're issuing an FRN? Okay, let's say the Intel FRN. Okay, due, same thing. Okay. Normally you don't have such long FRNs, but let's say whatever it is, let's say we'll make it 26. Okay. Now this, okay, here now what you have to specify is, because there's a problem here. Do you see something else has to be specified? FRN, you understand what FRN is? Huh?
So LIBOR rate has
FRN is a floating rate note. Okay, FRN stands for floating rate note. Okay, so let me just write it here if you don't want, because we haven't discussed debt capital markets. Okay, floating rate note. Okay, all that it means is it's just like a bond, but it's the coupon is not a fixed rate, but it's a floating rate. So it is priced at a spread over a LIBOR rate. Okay, but what is the problem with LIBOR? If I just say Intel FRN due 2026 priced at 210 over. Okay, is this information complete? Even if I write LIBOR, what is the problem?
the LIBOR rate is missing and the maturity of
1 minute. LIBOR rate is missing. LIBOR rate you can find from the internet.
and it is like LIBOR rate is subjected to change after every 6 or 9 months.
So that's why it's a floating rate note. Is my question clear? 1 minute. Let's be very clear about the question. Earlier, when I gave you information on the 5-year on the fixed rate bond issued by Kingdom of Saudi Arabia, if this news release tells you everything you need to know, okay, this will also mention 5% semi-annual or annual. Okay, this news release may not mention, because the 5% coupon, whether it's paid semi-annually or paid annually, those things will be mentioned. That you look at the term sheet. Okay, but it will really not be mentioned in the news release. Now. Intel FRN due 2026, it's a 10-year, let's say it's a 10-year FRN, okay, due 2026, and this news release is coming out in 2016. If we say priced at 210 over LIBOR, okay, let's make it a different spread. Okay, even if they write 75 BP. Okay, what is the problem here? What information is missing? Is my question clear?
Yes.
So Intel issues a 10-year FRN in 2016, let's say, which is priced at 75 basis points over LIBOR, okay, and it's due in 10 years. Now, obviously, now here there is no mention of coupon. There's no mention of a coupon. Is that clear? There's no mention of a coupon because this is a fixed rate. This is a floating rate bond, okay, a floating rate note. So there's no mention of a coupon, okay. Now that's why what they're mentioning is 75 basis points over LIBOR. Okay. Now what is the problem? What information is missing?
Credit rating.
You don't need the credit rating. It's only telling you how much Intel has had to pay. It's reporting on a bond issue, on an FRN issuance. Yes.
Size of bond. Say US government bond.
No. Okay. Let me just save time. And it's not the size of the bond. The point is, LIBOR is how many LIBORs do you get?
Maturity.
LIBOR is in London Interbank Offer Rate. Okay, so this is actually a money market rate. LIBOR is a money market rate. When we did our case on this Magma Resources, didn't I give you guys a write-up on LIBOR?
Yes, you will.
So is LIBOR fixed for how many maturities is LIBOR fixed for?
6 or
6 months.
It's not just for one maturity. LIBOR is fixed for 1 month, 3 months, 6 months, 9 months, 12 months. Okay, it may be done for 2 months also. Okay, so London and LIBOR is fixed for different maturities. It tells you all the borrowing costs of the money center banks in London for various maturities. So LIBOR on any given day is published for multiple maturities. So you have 1 month LIBOR, you can have 2 month LIBOR also, 3 month LIBOR, 6 month LIBOR, 9 month LIBOR, etc. So what is missing here is the particular benchmark of for the FRN. when you are setting a LIBOR benchmark for an FRN, you need to fix the term of LIBOR. Okay, you need to specify. Most of them will be for 3-month LIBOR. Okay, most of the FRNs will be issued against 3-month LIBOR, because remember, 3-month LIBOR is not the same as 6-month LIBOR.
Yes, sir.
So on any given day, you will have fixings for 1 month, let's say 2 months, and then 3 months, 6 months, 9 months, 12 months on any given day for each currency. Now I think they're doing US dollar. They kicked out Aussie and Canada, so under the new system. So now you have US dollars, sterling, and probably Swiss francs and yen. Okay, maybe 4 currencies. Okay, but for each currency, they're going to fix LIBOR for at least at least for 1 month, 2 month, 3 months, 6 month, 9 month, 12 months. Okay, is this clear? So the 1 month on any given day, 1 month LIBOR is not the same as 3-month LIBOR. The value. Is this clear? Because your borrowing rates are not the same for different maturities. So therefore, when you're fixing a benchmark for a floating rate debt issue, you need to specify what is the term of LIBOR against which you're benchmarking. Is it 6-month LIBOR? Is it 3-month LIBOR? Is this clear?
Yes.
Otherwise, the information is not complete. So here I've written 3-month. Most of the debt issues are going to be against 3-month LIBOR, because that's that also when you study interest rate swaps, most dollar interest rate swaps, the standard LIBOR reference is to 3-month LIBOR. So because most people would like to have the option to swap into fixed rate dollars later on to keep the regularity in the maturity, they usually would issue the FRN against 3-month LIBOR. But it's not like a hard and fast rule. You can also decide to issue against 6-month LIBOR. All that it means is that if you're issuing against 3-month LIBOR, means your interest rate gets reset every 3 months. Okay, remember this is bond issued in 2016. This bond is issued in 2016 and it matures in 2026. Okay, so every 3 months, so you only know when you issue the bond, you know the fixed interest rate payment only for the first quarter. Second quarter's interest rate you don't know now. You will know it only after 3 months. Is this clear? That's why it's a floating rate issue. Alright, so these 10 essentially are 39 quarters. 10 years, you have 4 quarters in every year, 40 quarters total, but the first quarter's interest rate is known. Because when you issue the FRN, you already know what the LIBOR is for that day. So 3 months later, you'll have to pay interest according to that interest rate. But whatever you have to pay for Q2, Q3, Q4, and all the next 39 quarters, that is not known to you. Is this clear?
Yes, LIBOR is decided depends on the liquidity in the market.
That's why I'm just coming to that. That's why it's called a floating rate note. Is everyone clear about this? Okay. So then obviously for FRNs, you have to mention when you're talking about the benchmark, it's LIBOR, you have to mention whether it's HIBOR, LIBOR, MIBOR, whatever it is. Okay. That you have to mention, and you also have to mention the maturity. I mean the term of LIBOR. 3 months, is it 3 months, is it 6 months, is it 9 months, against which it will be measured. Is this clear? Yes, go ahead. What is your question? Use the mic if you can.
The LIBOR is depending on the liquidity in the market or the demand and supply of the money in the
LIBOR interest rate. Yeah, so see, what is LIBOR? If you remember, does anyone remember how LIBOR is fixed? Okay, so there have been some changes to the mechanism. Now it is called ICE LIBOR. ICE is the Intercontinental Exchange, because there was a massive LIBOR fixing scandal, okay, that happened in the aftermath of the GFC, okay, in 2008-9. So essentially how LIBOR used to be fixed was the British Bankers Association would go and call, because remember London is a very big financial center, so you have banks from all over the world, Sumitomo, Mitsubishi, Westpac, everybody, Canadian Imperial Bank, etc. Everybody's got big branches in London, and they're all borrowing between each other, from each other, lending to each other. This is called the Euro markets, okay? So in this market, when they're borrowing with each other, lending to each other, the BBA, the British Bankers Association, would poll. So it's a survey. LIBOR was a survey essentially. Today it's also a survey, but it's better controlled, hopefully. So it was a survey, okay, and they would survey the banks and say, okay, you call up Barclays London and you say that, okay, today if you have to lend to your other money center banks, okay, at what rate will you lend for each of these maturities? So then Barclays will say that for 1 month I would lend at, or at what rate are you able to borrow? Okay, then they will be separately polled also for lending. So you're at what rate do you think you can borrow for these maturities? Okay, is this clear? It's a survey. So you call up the various banks and you figure out what are their borrowing rates for various maturities in each of those currencies. And the earlier days they used to have Aussie and Canada as well.
Those banks who have surplus funds would like to lend at the lesser interest rates, and those who
So why would you lend at the literature? Then I want to borrow money from you. If you want to lend, if you're a lender, you want a lower interest rate or a higher interest
those
rate?
who have, they would like that their money should be given to those, their money should be lended. And if
Not lended, there's no such thing as lended. Lent.
lend. So sir, जो भी
Use the mic, use the mic. Where's the mic?
Sir, those banks would which have the surplus funds would
The
like
mic
to,
is not working. Yeah.
Those banks which have the surplus fund would like to that their funds must not be freely put as reserves in their balance sheet.
Yeah,
So
the
they would
funds should
like-
not be idle. They want to lend their funds. Yeah. So essentially, you have surplus and deficit funds. It's just like what we discussed in the general capital markets case. Okay. So they would be borrowing and lending from each other. So it's a survey. LIBOR is a survey of these various banks trying to figure out at what rate they are able to borrow today. At what rate do you think you can borrow today for 1 month, 2 months, 3 months, 6 months, 9 months in say Swiss francs? And then repeat this exercise for all the other currencies. And then you poll, I think they were polling about 11 banks or 14 banks, and then they would leave out the two most extreme observations and then take an average of the rest. Okay, so this is just a survey data. I mean, essentially LIBOR is survey data, but LIBOR is very important because trillions of dollars of debt worldwide are priced off LIBOR. Okay, literally because the US capital markets are, the US dollar capital markets are the deepest in the world. So everybody is trying to issue in those markets, and the volume of debt which is priced off LIBOR is massive. Okay, huge amounts of LIBOR, and now they're trying to transition to some other benchmarks as well. I forget the name of the benchmark. I think it's secured something. I'll have to look it up and tell you. But there's a new benchmark now, which the US, I think it's this SOFR. It's called Secured Overnight Funding Rate. Okay, SOFR. Because of the scandals in the LIBOR fixing, they have tried to move towards, because LIBOR is based on survey data. Okay, LIBOR is based on survey data.
the data must be biased.
Yeah, so this whole LIBOR scandal, you guys should also be aware of this. What happened in the LIBOR scandal is because many of these money center banks had bad assets on their books. Okay, as you know, many of the banks had to be taken over. They had to be bailed out by the government. So they had a lot of bad assets on their books. So their credit ratings essentially, I mean, they were downgraded much later, but the market did not want to lend money to them. Okay, the market was very wary of dealing with them. So therefore, they wanted to understate the rates at which they were able to borrow. Actually, they were not able to borrow at such high rates, but they lied essentially. They lied about, that's why LIBOR started being referred to as LIBOR. So the joke in the industry was this, that LIBOR was called LIBOR. Okay. So this was called LIBOR, and there's this was a very big scandal actually. This is a case study in itself, LIBOR, and so what happened I got distracted because I saw Gunjan looking at the clock. So, all right. So this was called LIBOR because the banks. So you have to understand the LIBOR scandal. We don't have enough time to cover it, but at least you should understand the basic idea. First, you have to understand that LIBOR used to be a survey. It is still a survey as it stands, okay? But hopefully it's conducted with better checks and balances. So they would just go and ask the banks, how much do you think you'll have to pay to borrow at 3 months, for 3 months in Swiss francs, 9 months in Swiss francs, etc., and repeat for all the currencies.
It's like we fix our monetary policy or any central bank fix.
Sorry?
So why not we
Use the mic.
Why not we fix the LIBOR rates?
As we decide our monetary policy or any country economy decides its monetary policies, like there are 5 people in the monetary policy and they vote in favor or against the.
No, that LIBOR is intended to be a market rate. So what is actually happening in SOFR? What is happening in SOFR is in SOFR they are trying to move from survey data. They're trying to move from survey data to actual transactions. So the idea behind SOFR is to now base the cost of borrowing on, instead of basing it on survey, which led to all these problems of the scandal of LIBOR. They are trying to now base it on actual borrowing transactions in the market between money center banks. So that is much more realistic because actual transactions don't lie. Okay, no one will lend to a poor credit at a low interest rate. All right. So essentially, what happened was try to understand the LIBOR scandal. This is also important from the point of view of understanding the history of financial markets. That essentially what happened in LIBOR, because in the GFC, all these residential mortgage bonds were falling. Okay, the banks had bad assets on their books. Nobody would lend to them. So the banks tried to understate their risk, the quality of their, the problems with their credit quality. So when they were being asked at what rate do you think you can borrow, they were actually quoting very low rates. But in fact, they were not able to borrow at those rates. They were able to borrow only at much higher rates. But if they had disclosed to the market that the cost of borrowings for banks is going up, markets would have concluded that this means that people think these banks are much riskier than we think, right? Obviously, you will charge higher interest rates if you are going to lend to a riskier borrower, right?
So profit would be eaten up by the debt and the interest payments.
Yeah, profit would be eaten up by the interest payments. So these banks, they wanted to conceal the extent of the credit problems on their books and the decline in their actual credit quality, and so they started to lie about the rates at which they were able to borrow. So LIBOR became artificially depressed and artificially low, okay, for this period. And eventually the scandal was investigated, a lot of people were sent to jail.
That's why
okay.
there is need of regulators in the market. The other day you were saying that we should free the markets. That is what the need.
Well, I don't agree because actually in the first place it was a stupid system to base such an important index on survey data. You could have already seen the conflict of interest, that if there is any situation where banks have everything in economics is based on incentives. Okay, economics, most of the laws don't work, but there's only one law that always works. Okay, which is that people respond to incentives. Okay, so if you had a system which is basically like somebody has a famous quotation that you show me the incentive and I'll show you the crime. Okay, you have to see where the incentives of people are in the system based on the system how it's designed, and you can already predict what kind of problem is going to come up. So it was a stupid system in the first place. Okay, and so this move towards SOFR is much better because it's based on actual transactions. All right, you'll get slightly delayed data, but that still work okay because the quality of the data is much better. Okay, so I don't agree that it necessarily requires regulation. I mean, this is not a case for regulation. Okay, so is this point? So LIBOR, essentially, that's the problem. That's a LIBOR scandal. So eventually, they investigated these people and they put them in jail. All right. Okay. So this is the pricing of floating rate notes and fixed rate notes. Okay. Now let's quickly go. This I've already written and I've already told you guys about all this. Okay. I think this is also, I've put this in your folder. So the last thing that we have left. Remember, the entire discussion is happening in the list of to discuss the prototypical firms in the financial services sector. And the last entity that we have, while discussing the government treasury, we had a long discussion on the debt capital markets, which is very important for you to understand how the market works. Okay, so the last thing that is left is the corporate treasury, that is the CFO's office. Okay, we can, okay, let this be. So this will just, okay, one last thing I wanted to tell you before this. This is a very common mistake that people make in the market. So I just wanted to write down two statements which you should be aware of. Okay, it's common sense, but one problem that you'll have is, let's say, I'm not going to write yields, I'm going to write YTM. Okay, this is one mistake that many so-called professionals also make in the market. So you need to be aware of this. You should not make this mistake. It's very common sense actually, but still people make this mistake. So remember, what are the two components of the treasury yield? One by one. Give him the mic, give Gava the mic. Is the question clear? What are the two components? It's like I ask you, what are the two components of chocolate? Let's assume it's cocoa and milk. Okay, and sugar, cocoa and milk and sugar. So in that sense, I'm asking, what are the two components of the treasury yield? What is the treasury yield made up of? It consists of two parts.
Real rate and expected.
Right, yeah. So the target the investor's real rate of return. So you can call it the target rate of return, and the TROR and expected inflation. Okay. So one mistake which you see very often people even in the markets make, okay, even so-called experts, they see a rise in the treasury yield. Okay, like you see a rise like this in the treasury yield. If you look at this data from just this this entire rise that has happened here. Okay, this is from the time of the 2016 election. This rise in the treasury yield, people were saying that, so you'll see that there's a rise in the on any given day. If the treasury yield goes up, an expert will come up and say, oh, the market's inflation expectations are going up. Okay, but as Mansi has just clarified, the treasury yield consists always of two parts. This is mechanical, okay? Target TROR plus expected inflation, okay? So do you think it's logically correct to if you see a rise in the total treasury yield, can you always necessarily assume that the inflation expectations have gone up?
No.
You can't. You have to check what happened to the TROR. Obviously, is that correct?
Yes, sir.
Is that logical?
Yes.
Because you don't know which component went up by what amount. Okay, maybe one component went up and one went down, you don't know. Okay? Sorry?
So we are changing the weight of giving something component. We are changing the weight. For example, for some time we are considering the growth as a factor, and we are giving, the market is giving the more.
Yeah, you can look at it as changing the weight, but there's no weight as such here. It just consists of two parts basically. Okay, there's no concept in a mathematical sense. There's no weight, but I understand what you're trying to say, that the market gives. So please don't make this mistake. If somebody makes this mistake, you point it out that the treasury yield is. I'll tell you why. Actually, I did some research on this part. If you see the rise in the interest rate since this low, okay, to this high, from this low to this high, okay, you will find that actually. And where do we find the TROR? Treasury yield you can find from the US Treasury website. And what is the TROR? What did we discuss? Where can I find the TROR? Yes? TIPS yield, right? The TIPS yield is the TROR. Okay, the TIPS yield again you can find from the US Treasury. Okay, so therefore when you see that, let's say the total treasury, the all-in treasury yield has gone up from say, let's say this point, whatever, let's say it has gone from this here, 1.3, say it's gone from 1.3 to 3.3, okay? So the total treasury yield has gone up by 2%. Now what you have to go and do is, before you make a statement about what has happened to the market's inflation expectations, you have to go and check what happened to the TIPS yield in the same period, okay? So if you do the research on this, you will find approximately about 67% of the movement in the treasury yield, the total treasury yield, is explained by a rise in the TIPS yield. Okay, so therefore it's not necessarily always true to correct to say that inflation expectation. Logically, that is not a correct conclusion. You have to first check what's happening to the TIPS yield. Is this clear? So the same logic applies to. So you have to go and check. As in, for instance, I can tell you because I've done the research myself for this part. Here, 67%, 2/3 of the rise is driven by the rise in the TROR.
Yes.
Which means essentially, and these things are important because a rise in the target real rate of return, you should understand, has very different implication. If you find that the market is radically raising the target real rate of return, okay, that has very different implications from another situation where the market is raising its inflation expectations. Because target real rate of return rising means market is expecting an economic downturn or upturn.
Downturn.
Upturn.
Normally we associate a rising target real rate of return with a
Upturn.
economic upturn. Because
Sir, my baat बताइए as well. Sir, in India we will focus on the down.
no, there's no India US in this. This is just theory. This is theory which applies everywhere in the same way. Target real rate of return is what the investor expects in from an investment. Okay. So obviously, if
you are looking at the corporate view,
yeah,
sir, it is against them.
Target real rate of return is always discussed from the investor's point of view, not from the corporate's point of view, not from the corporate borrower's point of view. Is everyone clear about this?
Yes.
If you have any doubts, let's clarify it now. So, I mean, don't just take it just because I'm shouting and telling you this, okay? That the target real rate of return, you should understand it. If it doesn't make any sense, then you can think about it and you can ask me later or you can ask me now. Normally we associate the theory that doesn't change whether you go to India or Japan or US or wherever, okay? The theory is that TROR is rising means that investors are being more demanding because obviously as the economy is growing, there's greater demand for funds, okay? So therefore these people feel also that there is also more, the borrowers can pay more because there is a period of high growth. Therefore everybody's kind of making money. All businesses are making money by and large. Okay, because markets are expanding, so therefore revenues are growing, etc. So therefore the borrowers are also in a position to pay more, and the lenders also feel that, okay, if hey, you don't want to borrow from me, I've got a double A here who's desperate to borrow as well, because he also sees, everyone sees growth opportunities in a strong economy, right? Are you following the logic? Okay, so make sure you understand all these components properly and what they mean. By contrast to this, so rising TROR means the market expects a strong economic growth.
Strong economic upturn.
Yeah, strong economic upturn or growth. So that's why, and so what is explained is part, and you see how it makes sense, because this is the time because Trump was elected and he had promised tax cuts and radical deregulation. And radical deregulation had a huge impact on consumer confidence, small business confidence, okay? And this economic growth started picking up. Now you see wages are also going up. Then you got the tax cuts after 1 year. Unemployment has fallen, okay? And you got the tax cuts. So this is consistent with what actually happened as well. Okay, so the movement in the total treasury yield is 67% is explained by the movement in the TROR, which means that the bond market was expecting a period of strong economic growth, and which was actually borne out by the results.
But sir, in a long run, we have to keep in mind the perspective of both the investors and the corporate borrowers. So sir, it should not be the only statement that the increasing trend would be beneficial for.
What I'm trying to say, I don't know which part are you objecting to. What I'm explaining is the theoretical understanding, okay, of a rising TROR is that is normally associated with the market view. If you find that the TROR is increasing, okay, that means that the debt market overall is expecting a period of strong economic growth. Okay.
In India, if the central bank is rising the interest rate,
not rising, raising
the interest rate. So sir, it is not.
Use the mic.
The market is not considering it as a favorable instrument.
No, I understand what you're trying to say. What you're trying to say is that if rates keep rising, then it will be bad for the corporate sector. Okay, and that again, this is the narrative that normally gets played out in India. Okay, which to some extent is true in other countries as well. But there is something else. There's another part of the picture that is not discussed. That is that if you are actually, it is partly to do with maybe the overall macro. Dampeners on a potential economic growth. Okay, I'm talking about a period where the market is expecting strong economic growth. So so this logic is not 100% correct. See, what happens is if you are expecting a macro period in the macro economy, if you are expecting strong growth, like what you've seen in the first 2 years of the Trump administration in the US, it's been a dramatic economic turnaround. Wages are rising. Okay, economic growth is very strong. Okay, unemployment is falling, labor force participation is increasing, people are coming in. I just heard yesterday that Walmart is hiring truck drivers at $92,000 an hour, $92,000 a year. Truck drivers, these are guys who are coming out of jail. These are people who have no qualifications. Okay, so even people are coming out of jail. People who are high school dropouts, they are getting 92,000. Welders are being paid 6-figure salaries. Construction, there's a massive construction boom. Welders are being paid 6-figure salaries, and still they can't. There are 1 million jobs in the US for which there are no people. So that's why you see that they are actually going to see. Now you see this. There's also a narrative in the Indian business press that the immigration restrictions are not going to be. Actually, in the long run, this is good for India if the US moves to a merit-based system, because most of the Indian immigrants they have merit. Most of them. You have some cheaters here and there who are going into fraud universities and all that. But by and large, most of our Indian immigrants from here to the US, they are all skilled immigrants. We are not like unskilled laborer from Mexico or Honduras or somewhere going there. Most of our guys are quite well educated. So this is actually good for India if they move to a skilled labor immigration system, which will take a long time, I think. But this is what. So are you following the discussion here?
Yes, sir.
Okay. So we are getting sidetracked once again a little bit. But the point is that rising TROR means market is expecting strong economic growth. Is this clear? Aryant is not convinced.
We can say in a long run, for a long run.
Yeah, I mean, if the point I was trying to make here is that in this narrative that I don't agree all the time that this rising interest rates means that it's bad for the corporate sector. Okay, yes, their cost of borrowing will go up, but the point is that if the funds are not going to be available unless you pay that marginally higher interest rate, okay, if you're looking at strong growth, then you don't mind paying that higher interest rate. That's another factor which never gets reflected in the discussion. Okay, part of the problem is our overall macroeconomic growth potential is depressed because of all kinds of bad policies.
Yes.
So if you have a booming economy, why are people paying $92,000? Why is Walmart paying Does anyone want to pay $92,000 to a truck driver? They could have also decided not to hire the truck driver, but they are hiring the truck driver at $92,000 because their business is booming. Are you following the logic?
Yes. Sir, but if any business is booming on the cost of debt, so then there is not a point to carrying on the business.
No. So use the mic first. What? 1 minute. If I am making total assets, 1 minute. This is also an important financial relationship you guys should be aware of. Okay. Let's go use this discussion to go because I want to make sure, because most of your interview questions are based on corporate financial statement analysis. Is that correct?
Yes, sir.
Most of your financial statements. Okay. Are you following what Goel said? Goel said there's no point raising money and borrowing money at high interest rates if now doesn't matter what the growth is, right? That's what Goel is saying. Okay. Now I'll write two more points here, but this is very important. Return on total assets. Okay. Who is -2? Who? Okay. No, okay, he's okay. I banned people from going out. No, but he should have asked me.
But sir, he was talking so high.
Yes, sir. It would have to stop everyone.
Okay, fine, no problem. Okay. But generally, if you want to go out, you have to inform me then. You should have just told me that I've never stopped anybody from going out when they're not well. Okay. 1 minute. This is an important thing you have to understand. Okay. Return on total assets, okay, is one. Then second is okay. So there are three factors. What Goel is saying is that no matter what, essentially what Goel is saying is the point I was trying to highlight to him, which I think everybody should understand, because again in the Indian debate this point does not get reflected. We have this standard, all these guys from FEB and ASSOCHAM go and start crying every time their interest rate should always be cut. Interest rate should always be cut. That's kind of also a little bit, I understand the logic, but the point is it misses the point. We should be emphasizing other factors which are holding back macroeconomic growth potential in this country, like improper tax system, then excessive regulation. That doesn't get addressed if all you're doing is going and crying about cutting the interest rate. So the point that Goel is making is, what Goel is saying, no matter what your return on total assets, if your cost of debt is going up, you should not borrow. That is, I'm twisting your words a little bit, but are you following what he's saying? Yes. That is kind of what Goel's message is. No matter what prospective return on total assets, obviously you never know actually what the return will be, but prospectively everything works on future prospects. All business investment is made based on future prospects. You actually really don't know what's going to happen, right? So what Goel is saying is that no matter what the prospective return on total assets, if your after-tax cost of debt is going up, okay, you should not invest. Okay, that's what he's saying.
Because return on equity falls.
No, but here's the relationship. This is the identity. Okay, this is the mathematical relationship. If my return on total assets exceeds my after-tax, so make sure you understand this. Okay, this is part of your financial statement analysis logic. Okay. So if your return on total assets exceeds your after-tax cost of debt, your ROE is always going to go up. If your return on total assets exceeds your after-tax cost of debt, your ROE is always going to go up. Okay, this is mathematical. There is no. Okay, is everyone clear about this? If you're not clear about this, please make sure you take some time to understand it, or understand it later. Okay, this is important. This goes into your module on financial statement analysis. Okay, which is what most of the interview questions are on, right? So make sure you understand. So what is Goel saying? So therefore what Goel is saying doesn't make sense. Okay, now you understand why corporates are willing to pay higher interest rates, okay, and why the TROR might go up in a situation where the overall debt market is seeing a dramatic economic upturn, okay, because investors see that, okay, if you are not willing to borrow money from me, he is there to borrow money from me, because everybody is looking for funds. Why? Because in an economic upturn, essentially what's happening is the prospective return on total assets is going up. So as long as I see a prospective return on total assets, okay, ROTA on, which is greater than my after-tax cost of debt. Okay, now remember here between 1 and 2, which is certain? Between 1 and 2, which is certain? Second is certain. At the time when I raise 5-year finance, okay, once I've locked in the raising of 5-year finance, my cost of debt is fixed. Unless it's an FRN, then I have a problem. But then again, I can do an interest rate swap and I can fix it in various ways. There are various ways to manage interest rate risk. But generally, so number 2 is certain. Okay, so I can lock in a certain on number 2, but obviously number 1 is not certain. Okay, number 1 is never going to be certain, pretty much. Okay. So, but if you are reasonably confident about getting a high number 1 compared to much higher than number 2, then you should always. So, if your ROE is projected to go up, you should invest or you should not invest? You should invest, right? Is this clear?
Yes, sir.
Okay. So, therefore, it's not true to say that you should always. So, what you said is not correct. So, there's also something to understand that when these people from FICCI and ASSOCHAM are going and always crying about lowering interest rates, that they are missing an opportunity to point the finger at other problems which are holding, other policy deficiencies which are holding back this country's macroeconomic growth potential. Okay, like the need for deregulation and all these kinds of things. Okay, so another point, so the first point that I was making is that the rise in the Treasury YTM does not necessarily mean that inflation expectations are rising. Okay, just for you, because TROR may have gone up. Okay, as I showed you in the case of the 2016-2018 rise in US Treasury yields, okay, that is 67% of that is explained by the rise in the TROR. Okay, so you have to check the TIPS yield also. The other mistake that people make obviously is therefore rise in due to okay, is this clear? Is everyone clear about this? Same logic. So if the total corporate debt, the total cost of corporate debt has gone up, it need not necessarily imply that the credit spread has gone up. You have to really check what has happened to each of the components. It may be that the credit spread went up, but the credit spread went down actually, but it was more than offset by the rise in the benchmark bond yield. So be careful about all these mistakes, because you will actually see professionals making mistakes like this with respect to the interpretation of treasury bond yield movements when they automatically attribute it to inflation expectations. Okay, so don't make this mistake. Okay, and so this other learning that we have related to financial statement analysis. All right.
Sir, all these things can change depending on situation.
What can change?
Sir, these assumptions can change.
Which assumptions can change? This does not change. This, 1 minute. This is mathematical. This does not change. Be clear about this. This is mathematical. The problem here obviously is that your ROTA is not certain. Okay, when Maruti is setting up its new plant in Sanand, they actually don't know what the ROTA will end up being. They have a projection. Okay, but all kinds of stuff can happen because it will take probably 10-15 years to realize all those returns. So those are, but the point is mathematically, if your assumption is correct about the ROTA being much higher than the cost of debt, okay, which is known to you, and the return on equity is just a residual in this equation. So this never changes. Mathematically, this never changes. The only problem in this is that the ROTA is not certain.
So suppose
At the time you take the investment decision, the ROTA is not certain. It is subject to whims, to the changing tides in the economy.
So suppose we have just started the business.
Yeah, 1 minute. Let us see if we have a time problem.
Yes, sir.
We have 3 minutes. We have 2 minutes. Okay. Yes, let him complete his question.
Sir, suppose we have started.
Use the mic. Use the mic. Okay, who's talking at the back? Yes.
Suppose sir, we have just started the new business. So sir, in the initial period, for say hotel business, so sir, the ROI would be much more lower than the
Again, much more lower.
than the cost of the debt. So sir,
So return, 1 minute. So return on total assets. So he's only talking about a situation where, again, this gives us an opportunity to link it to your placement decisions. Okay. Do you reject, if you have a project which has a positive NPV, but the first 2-3 years cash flows are negative, do you reject that project?
No, sir.
No. So similarly, when you are looking at your placement, don't take it based on the first 2-3 years cash flows. Look at the NPV of the project. Okay. So what he is saying is that the NPV of a particular project may be negative in the first 2 years. So when you are looking at this ROTA calculation here, the ROTA projection is the total return that you are expected to make. Okay, so you look at the IRR of the project. Here when I mean ROTA, I am talking about the IRR. That's a projection. You don't know what is actually going to happen. Is this clear? Have you guys learned anything today?
Yes,
Okay, very good. Okay, please remember, I'm going to send you that report, the spreadsheet format. I want people to respond quickly. Okay? All right. Who were the defaulting teams? I think I've shut that sheet now. Okay. So when you get them, make sure that everyone responds. Okay, you can go. 35 seconds. You get 25 seconds bonus.
Sir, I need to ask a question, sir.
Yes. Is it a technical question?
Sir, regarding to this only.
Yes. Go ahead.
5% bond over 210. Sir, there was.
Sorry, 5% bond. 1 minute.
ऐसे कुछ था ना सर,
1 minute. 1 minute.
ऐसे नहीं सर. So इतने सारे.
KSA 5% bonds due 2046. This is the one you're talking about.
हाँ ये वाला सर.
Huh?
हाँ ये वाला.
High yield.
This one only.
This one. Yes.
question.
What is your question?
So this 5% is the coupon rate. So then what is 210 to 210? This is the credit spread.
30 years 210 over. Yeah, that's a credit spread.
Credit spread. Sir ये use कहाँ होता है फिर credit spread से हमारे?
Sorry, 1 minute. Come again.
Sir जो हमारा bond होता है उसे
1 minute. Speak in English. I understand. 1 minute. 1 minute. I think your confusion is between coupon rate and YTM.
Yes sir.
So coupon rate is less important.
So YTM is just like the IRR of the bond.
Yes. Okay. Correct. Very good. Correct. Excellent. So YTM is like the IRR of the bond. Okay. So now the question is, don't get confused by the coupon is just incidental information, a piece of incidental information that is given to you to show you what the bond's coupon is. Obviously, when you actually buy the bond, the money that you're going to earn, the actual cash payments that will come to you on a semi-annual basis, or whatever the frequency is going to be based on the coupon. Okay. But what really matters in the market is the YTM. So YTM is the yield on the bond. It's the yield to maturity on the bond. Okay, it's the IRR on the bond, as you
Let's
correctly
say
said.
government bond yield is 5%.
Yeah.
Then the YTM will be 7.1.
Yes.
7.1%. Sir, but the YTM will include the coupon.
No. 1 minute. 1 minute.
Coupon is the dividend. It's just like the dividend.
The ITR, yeah, the IRR is the YTM is the IRR of the bond.
Yes, sir.
The coupon is just like that periodic cash flow which you're discounting.
Yes, sir.
You following?
Yes, sir.
So that periodic cash flow which you discount in the project to get the IRR.
Yes, sir.
In that place, when you're calculating the bonds of ITM, that periodic cash flow will be based on the coupon times the par value, the principal. So if it is a bond with $1,000 face value, you will get for every bond that you have bought 5% per annum. Okay, paid semi-annually, or let's say assume for the sake of simplicity annually, then 5% on the $1,000 face value. Coupon will be paid for you for every bond. That is your cash flow. So the cash flow is different from the discount rate. The basic structure of your project return analysis, etc. The cash flow is different from the interest rate, from the discount rate. The IRR is a discount rate. Yes. So and the cash flows are the coupons.
Sir, I got all this.
Yeah. So what
Sir,
is
I
the
know
confusion?
this. Sir, the thing is that these bond prices change in the market.
Yes.
Sir, but the YTM remains the same.
No. The coupon remains the same.
Coupon remains the same. YTM will change the next year.
YTM, see, 1 minute. Coupon remains the same.
Yes, sir.
If coupon remains the same and the prices are changing in the market,
Yes, sir.
then is the YTM remaining constant?
No, sir.
The YTM will change as the prices change.
Yes, sir.
Okay? Because remember the YTM, the price, think about this. 1 minute. Go back to there's a good example that you gave. The price, the price of the bond is equal to the cost of the project. Think of the price of the bond as the cost of the project.
And inverse
when your
to the YTM.
IRR is basically on the right hand side. One way of writing the IRR is on the right hand side you put the actual project cash flow values, NPVs of the cash flow value. And the on the left hand side you put the project cost.
Yes, sir.
When the two are equal, then the IRR is that is the IRR of the project. That is the discount rate. Okay, so here if you want to put the bond pricing into that framework, the cost of the project will be the market price of the bond. The cash flows will be the coupon rates times the principal. Coupon rate times the principal.
Times the principal and plus the terminal redeemed value of the bond.
Principal value that plus at the last period you have the coupon payment, the bullet payment of principal. Okay.
Yes, sir.
And then the discount rate is going to be the IRR, that which makes the LHS equal to the RHS. Okay. Clear? Okay. Now you understand. So when the coupon doesn't change after the issue, the coupon doesn't change.
Coupon तो एक ही रहेगा.
Will be same. Okay. But what will change is that because the market wants to receive the market rate of return on the bonds, the market rate of interest. So the market will make the price go up and down to get the YTM that it wants.
That it was. Sir, एक लाख.
Is this clear now?
हाँ सर अब आ गया.
Okay. Now are you also following?
Yeah.
Go and listen to it. It's all recorded.
ये भी
Listen
record
to
हो रहा
it.
है.
Yes. That's why I asked you whether it's a technical question. Then I wouldn't stop the recording. Yes. So we had a long technical discussion. Yes.
So just last thing.
Yes.
Sir, I
You
got
can ask many things.
this first line is for the primary debt issue.
Yeah.
PCM. But for the next time when it will be for the secondary market. PCM. Secondary debt.
Yes. Yes. So I am talking about a news release about a PCM transaction.
So now I got it. Sir, I was confused that YTM should change every year.
The news media, like the specialized news media, like International Financing Review, they would not report on secondary market transactions unless there's something special. There's a large block trade or something.
So that was the reason I was confused that it should change every year. The YTM should
It can
change every
change
year.
depending on how actively it's traded. It can change all the time. Okay, clear? Okay, good question. And it's good that you understood that
Please explain that statement which one doesn't show me the incentive and I will show you the crime. What that statement exactly means.
incentive is essentially, come with me, I'll explain that to you. So incentive and showing you the crime means essentially people respond to incentives. See, why do people not talk that much in the class? Because they know if I catch them, they're going to lose CP points. So people are responding to incentives. If I did not do that, then they would talk a lot. Okay? So